solved problems. Reconciliation of actual profit versus budgeted profit. Problem. You are the management accountant of TPLC. The following computer printout shows the details relating to April. Actual budget. Sales volume. Actual 4,000 units. Budget 5,000 units. Selling price per unit 15 pounds. And as per budget 14 pounds. Production volume 5,400 units as per actual. As per budget it is 5,000 units. Direct materials kg actual 10,600, budget 10,000. Price per kg 0.60 pounds. Price per kg as per budget 0.50 pounds. Direct labor hours per unit 0.55 as per actual, 0.50 as per budget. Rate per hour 11.40 pounds as per actual, 12 pounds as per budget. Fixed overheads production. Fixed overhead production as per actual 10,300 pounds as per budget 10,000 pounds. Fixed overhead administration 3,100 pounds 3,000 pounds as per budget. TPLC uses a standard absorption costing. There was no opening or closing work in progress required. Prepare a statement which reconciles the budgeted profit with the actual profit for April. Solution. Let us prepare actual production account. Actual production, quantity, rate, amount, expenses, quantity, rate, amount, income. On the credit side, sales 4,900 units at 15 pounds, amount 73,500. On the debit side, direct material 10,600 units, rate 0.60 pounds, amount comes to 6,360 pounds. Direct labor 2,970 hours, per hour 11.40 pounds, so the cost coming to 33,858 pounds. Fixed overhead production 10,300, fixed overhead administration 3,100. Total production cost is equal to 53,618 for 5,400 units. The units sold are 4,900. That means there is a closing stock 500 units. The average cost of production 53,618 by 5,400 is equal to 9.93. 500 units at the rate of 9.93 comes to 4,964.63. Total revenue including closing stock is equal to 78,464.63 less cost of production 53,618. The balance 24,846.63 comes to profit as per actual. Profit as per actual figures is profit as per actuals is 24,846.63. Let us prepare budgeted production account. Budget. On the credit side, sales 5,000 units at 14 pounds 70,000. On the debit side, expenditure side, direct material 10,000 at 0.50 pounds is equal to 5,000 pounds. Direct labor 2,500 hours at the rate of 12 per hour 30,000. Fixed overhead production is 10,000. Fixed overhead administration is equal to 3,000. Total production cost is equal to 48,000 for 5,000 units. So the total income is equal to 70,000 as per budget and the less cost of production 48,000. The difference 22,000 is the profit as per budget. Profit as per budget figures is 22,000. Let us prepare the variation statement. Particulars, actual, quantity, rate, amount, budget, quantity, rate, amount, variation, amount. Sales as per actual 4,900 into 15, 73,500 as per budget. 5,000 into 14, 70,000. Variation 70,500 minus 70,000, 3,500. Closing stock 500 units at the rate of 9.93, 4,964.63 as per budget nil. So the variation is 4,964.63 less cost. Direct material 10,600 at the rate of 0.60, 6,360 pounds as per actual. As per budget 10,000 into 0.50 pounds 5,000 pounds. Variation 6,360 minus 5,000, 1,360. in the material. Direct labor 2970 hours at 11.40, 33,858 pounds as per actual. 2,500 at the rate of 12 per hour is 30,000 as per budget. The variation is 33,858 minus 30,000, 3,858. Fixed overhead production as per actual it is 10,300. As per budget it is 10,000. The variation 10,300 minus 10,300. Fixed overhead administration as per actual it is 3,100. As per budget it is 3,000. Variation is 100. Total variation in the revenue is 8,464.63. Total variation in the costs are 5,618. Total variation in the profit is equal to 24,846.63 as per actual, 22,000 as per budget, and the variation is 2,846.63. Let us prepare the reconciliation statement. Reconciliation statement. Particulars amount. Actual profit 24,846.63. Add variation in cost of direct material 6,360 minus 5,000, 1,360. Add variation in the cost of labor 33,858 minus 30,000, 3,858. Add variation in the fixed production overhead 10,300 minus 10,300. Add variation in the fixed admin overhead 3,100 minus 3,100. Total 5,618 is to be added to the actual profit for the purpose of reconciliation. Less variation in sales revenue 73,500 minus 70,000 is equal to minus 3,500. Variation in the closing stock 4,961.63 and as per budget it is nil. So 4,960.53 plus 3,500 total minus 8,464.63. 24,846.63 plus 5,608 minus 8,464.63 is equal to 22,000 profit as per budget. This is the reconciliation statement. Recap. Thanks for watching. Please subscribe to our YouTube channel Accounts Lobby for various solved problems and lectures on accountancy.